Brad Williams, Frugal Finance. Let's continue talking about hedging. How about some just basic hedging ideas? A wheat farmer wants to protect the pricing of his wheat crop, and a baker who needs wheat and wants to cap the price of future wheat pricing. Hedging or risk reduction is available for both parties through futures contract. Futures contract is a standardized forward contract traded on an open exchange. Forward contract is a typical bilateral agreement between two or more parties for the actual delivery, payment of goods, services, or exchanges. A farmer is expecting 100,000 bushels from this year's crop available in 1 month. The forward price for delivery next month is $2 per bushel. A baker needs 100,000 bushels of wheat for delivery next month. The farmer agrees to sell to the baker for delivery next month 100,000 bushels of wheat for $2 per bushel. Farmer is responsible for the cost of delivering wheat on a specific date, but otherwise, the farmer and baker have hedged their wheat requirement. The farmer has insured against lower wheat prices, and the baker has insured against rising wheat prices. However, unless farmer and baker know each other, arranging such a transaction would be cumbersome, and why future contracts come into play. Typically, the farmer will sell his wheat to a local co-op or supplier, and a baker will typically buy wheat from a local distributor. By using wheat future contracts and saving on shipping costs, the farmer can sell his wheat through a futures exchange, or at least hedge his future crop with future contract. While the baker can buy or hedge future wheat price increases using future contract. Pretty simple. Yeah, from an outsider looking in, this may seem confusing, but on a day-to-day basis, you're just putting in an insurance policy. The downside is if you hedge, there's that potential, there's that, what do they call that? The black swan, that rare occasion where something radical will happen and wheat prices will go from $2 to $4 overnight. What's the probability of that happening? That's what you have to consider. But on average, if you are taking a very conservative route, then hedging is the way to go. Because the farmer owns the wheat and wants to protect against lower wheat prices, the farmer will short wheat future contract. One wheat future contract equals 5,000 bushels. So the farmer will short 20 contracts at $2 per bushel times 5,000 times 20 equals 200,000 for delivery in 1 month. If wheat prices move higher, the farmer could sell his wheat to a local distributor, but will have to pay to cover the 20 short wheat contracts. Remember, you're still committed to your contract. It goes against you, but you're going to sell to the distributor and you're going to cover whatever the difference is, and it should net zero, other than your time to sell the distributor and then buy this short position back. Let's say wheat prices increase to $2.20 per bushel. The farmer will receive $220 from the local distributor and pay $20,000 to cover the short position, netting $200,000. You see how that works? If wheat prices drop to $1.80 per bushel, the farmer will lose $20,000 on his wheat, will make $20,000 on the short position to net $200,000. The zero-sum game. That means whoever went long in the futures position and didn't sell it out before the price dropped to $1.80 is going to take that $20,000 hit. The same holds true with the baker. If wheat prices move higher or lower, the baker will not pay more than $200,000 for the 100,000 bushels of wheat. Now, suppose you're a wheat speculator and you gather information on all the supply and demand factors that determine the price of wheat, such as total acreage planted, rainfall, production plans of major baked good producers, and so on, and come up with forecasts of next month's spot price of wheat. Say it's $2 per bushel. If the current futures price for delivery a month from now is less than $2 per bushel, you buy the futures contract, you take a long position because you expect to make a profit from it. To see this, suppose the current futures price for wheat to be delivered a month from now is $1.50 per bushel. By taking a long position in this futures contract, you lock in a price of $1.50 per bushel for wheat to be delivered a month from now. Since you expect the spot price to be $2 at that time, your expected gain will be 50 cents per bushel. On the other hand, suppose that the current futures price for delivery a month from now is greater than $2 per bushel, your forecast, say it's $2.50 per bushel. Then to earn an expected profit, you sell the future contract, take a short position. Taking a short position in this future contract, you lock in a selling price of $2.50 per bushel for wheat to be delivered a month from now. You expect to be able to buy wheat at a spot price $2 per bushel. You therefore expect a gain of 50 cents per bushel. So then you'd have to take into, we have a margin requirement. You have your bushel, you have the price, contract value, typical margin, 924.38, 5%. And then price on August 5th, 363, difference 0.7, margin reduction 362.50, current margin balance. So what does this mean? This means you buy a contract. Is this one contract? 5,000, 1848, and the price is 370. Let's just say it's 1848. This 924, you're going to have a daily margin requirement, and it's typically 5%. Do this real quick. Equals this times 0.05. The 924.40. What happens here if price on August 4th, whatever, is 370, and if it drops, this margin position, this is for each contract, is going to change. If it dropped to 370, then this price right here is going to drop and your margin is going to be different. Now, if this number gets too small, in other words, your margin, no, if this price goes higher and your margin requirement escalates and you don't have 924 in your account, you're going to get a call. You have this margin balance. If it's below a certain requirement, then you're going to get a call, and you do one or two things. You either wire money to the commodity group, or, and they have very little patience for this, they'll sell your position to cover that loss. That means you don't have enough money to cover this commodity, so they'll close it out. They'll close it out and they'll subtract your loss, and then they'll attach a lien on you. Serious business. And you see this all the time. You get your gamblers out there and they are shorting the S&P 500 futures contract, and they don't hedge themselves. In other words, they just don't hedge. And subsequently, there's that obscure situation where the market just tanks within minutes. So now all of a sudden, your margin requirement skyrockets and you don't have the money to cover it. The rules of the commodity exchange is they'll sell out that position to cover that loss. More to come. Brad Williams, Frugal Finance. See you soon.